Yesterday, the 3M board declared a quarterly dividend of 70 cents per share, therefore indicating a dividend cut of negative 54%, which is massive for this previous dividend king, and therefore the forward yield is now 2.78%. It is one that I did hold, and now I have officially sold out of my position after their dividend cut, and we can see it does currently trade around the $100 mark. So in today's episode, we're going to do a deep dive of this company, look at the numbers in terms of their revenues, their bottom line, net income growth year on year. We'll look at the health of this company, their total cash, their total debt, while I explain what I like, what I don't like, and why ultimately I have sold out of my position. And as always, we'll look at both insider movement as well as institutional buys and sells. We'll also talk about the impact of this new dividend yield moving forwards. We'll talk about the unsafe nature of this dividend even after the dividend cut. We'll look at some of the underlying metrics, again, some of the positives, as well as some things that if you are a shareholder to be aware of. And we'll take a look at some slides from that presentation just a couple of weeks ago, again, explaining our rationale for our move. And as always, we will run them through the valuation model. We want to get to what we believe to be the intrinsic value based on this calculation. What is our acceptable buy price? What is our investor margin of safety? And as well, what do Wall Street see for upside of this company over the next 12 months? Is it something that really you should consider as a buy, a sell, or even a hold? Now, before we do jump into this episode, just to let you know, we have literally minutes ago released our latest free weekly article where we run through 20 undervalued dividend stocks. If you want to gain access to this article or any others, all completely free, do click on that pinned comment below to sign up for instant access. And we also want to let you know that how to find undervalued stocks. In this article, we do discuss all the websites and resources we use to individually analyze these companies. So as a reminder, this is a company that is down around negative 0.41% over the last 12 months. Year to date, however, it is down just over 8%. And if you've been a long-term shareholder, you would be down negative 29%. Bear in mind, if you were to reinvest those dividends, you would be up, although marginally higher. And we can see all-time highs at the beginning of 2018 around $259. Now, it does currently trade in the midpoint of the 52-week range. And as we can see, the dividend yield or rate, in fact, moving forwards, $2.80, hence why it is around 2.8%. We do note Seeking Alpha are yet to update this number, but the yield has been cut and it does sit around that 2.7, 2.8%. Forward P, however, sitting around 14.04. Now, in terms of the numbers of this company, as always, with any company that you invest in, on the top line revenue, you do want to see growth at a bare minimum of 3 to 7%. We note 32 billion in 2014 and around 33 billion in 2023, indicating over the last 10 years there has been relatively minimal growth. If you factor in inflation, again, you wouldn't see any real rate of return on the top line. And we can see in a graphical format as well, very minimal growth over that longer term. When we look at their bottom line, their net income, what we notice, 5 billion, in fact, net income 2014, a loss of negative 7 billion in 2023. And again, we can see on a graphical basis, relatively little movement. So again, something just to consider whether or not this is a company you're looking to buy, or even if it is a company you're looking to sell. These are some things you should analyze and edit into your own investment thesis moving forwards. This is just our analysis that we are doing for you to listen along. In terms of looking at the health of this company, so their total cash versus their total debt, 3.3 billion in 2014, around 10.9 billion in their latest quarterly report, which we will discuss as this has come from essentially some of the spin-off of Solventum. Now, in terms of comparing this number numerically and directionally, always very important rather than looking at cash in isolation. To look directionally, we do notice it has gone up from around 6.9 billion to around 22.3 billion. So whilst even their cash has gone up, we notice their debt has gone up at a much faster rate. And we can see over the longer term, total debt does move upwards. And in fact, their cash position currently does not, or in fact is not large enough to pay off all of that total debt, something we will consider when we do look at that dividend safety, which even now after the cut does look to be unsafe. Another thing that we do like to do is look at their EPS versus analyst targets, as well as moving forwards the estimates. What is nice to note, over the last 4 quarters, they have a 100% track record at beating the consensus. In fact, just the last quarter, Q1 of 24, they did beat by 28 cents. The thing that we do want to point out here is very good 100% track record, but over the next 4 quarters, in terms of that EPS, their earnings per share, it is anticipated that year on year we are expected to see double-digit negative growth. Now, you could argue again, this is a company which has been taking a massive hammering with a lot of risks around the litigation, which we will cover as well as part of their presentation, but just something to factor into your own investment analysis as well. The growth isn't expected to be massive right away. Now, when we take a look at their valuation, so this is the underlying metrics and the grade, they do get an A. One of the things that we want to point out is the P on a non-GAAP basis, 14.04, sector median around 19.25, and what we do see here is it is trading at around a negative, or in fact a 27% discount to the sector, which is positive. Again, this is only if this is a company that you are looking to invest in. 14 versus 19 on a P basis. In terms of other metrics, you can see here, there will be some that some investors prefer to use than others. You have the information here, but on the one that we typically look at a very high level, it does get a B+, with an A grade overall covering all the valuation metrics. In terms of looking at the growth grade, well, they do get an F. The reason for this, firstly, year-on-year growth, negative 2% versus the sector median around 5%. Forward looking, negative 10.5, when we see here the sector coming in a lot higher at 6 as well as being positive. And when we look at some others, one of the ones that I personally like to draw your attention to is this earnings per share on a forward basis. Over the next 3 to 5 years, it is expected to decrease by 3% year on year, whilst others in the industry, yes, they may be trading at a higher PE as we saw earlier, but they are anticipated to grow double digits, 12.1%, and these are the other metrics if you do want to factor these in as well. Then when we take a look at the profitability, well, they get an A+, so a very strong stamp of approval there. In terms of gross margin, 44.6 versus the sector median of 31. Bottom line, however, negative 22%, although that is just that one-off in 2023, with the sector median around 5.93%. When we look at the other metrics, looking fairly strong. Cash from operations significantly high, 6.17 billion, with others in the sector of 309.75. Now, in terms of a quick summary, we have, as we haven't mentioned already, Seeking Alpha give it a buy rating, whereas Wall Street and Quant give it a hold. And as we mentioned at the beginning of the episode, this is one that we have officially now sold out of. In terms of valuation, they get an A grade, growth F, profitability A+, but as always, do your own due diligence. The information is just here for you to base some of your analysis off. And then in terms of looking at how they've performed versus others in the sector, well, we have others in the industrials industry, Hitachi, Icahn Enterprises, Smith Group, as well as a few others. What we noticed over the last year, now total return, including dividends reinvested, 3M is up around 7%, still one of the worst performing as we can see. Over the last 5 years, down 29%, but however, we notice not one of the worst performing, and what we can see is the industry as a whole hasn't performed very well. Half of them have returned negative over the 5 years, and over the last 10 years, we notice pretty much flat. So in conclusion, if you were an investor of 3M 10 years ago today and you were reinvesting your money every single quarter, putting those dividends back into work for you, you would essentially have a total return of 0. You would be flat. Now, the key thing to understand from all of this information is that past performance is not an indicator of future. So just because they perform very poorly over the last 10 years, it doesn't mean they will perform as poorly over the next 10, but the information is here as well, whether or not you do want to consider that moving forwards. In terms of insider ownership, well, 0.38%, we noticed 2 instances of insider selling over the last 12 months, with a total of around $1 million. Although what we'd have to do is you'd have to go back to Q1 to see $39,000 worth of sales, and then around Q2 for a larger amount of around 1.62 million. And then when we take a look at who these insiders are, we can in fact see on the 14th of February an insider of around 426 shares, selling for around $92, so in fact slightly lower than the current trading price, for around $40,000. We do note another insider, but again, quite some way away, nearly a year ago today, in fact, over 9,000 shares for just under $1 million. For me, this is too outdated to be included in your own investment analysis, and this is probably too trivial to consider, but as always, information is there. In terms of US Congress members, it isn't something that we pay much relevance to, but again, you can see that there has been a fair amount of buying in 2023 with the US Congress members. In terms of institutional ownership, where it sits at 65%, we see around 4.3 billion worth of sales by the institutions over the 12 months, with in fact double over the same time period. So more buying than selling by institutions. But what is very interesting to note, in the latest quarter, Q1 of 2024, we do actually note more selling, 917 million versus 687 buying. So again, quite interesting to see that over the last 12 months as a whole, yes, institutions have been buying 8 versus 4 billion. However, in the latest quarter, we see that trend reversed. Again, do your own due diligence. Don't copy institutions, don't copy insiders, but just the trend that we have spotted. Now, before we do jump into the dividend safety and take a look at some of their underlying metrics, we do want to talk about a few slides just in case you missed it from their latest quarter earnings. First one that we do want to note, 3 different pillars. So the first one is their performance. So for the quarter, they did have revenue around 7.7 billion, which they did put a lot of emphasis on their organic growth, which has been rising quarter on quarter. They talk about essentially their adjusted OI, so their operating income margin of around 21.9%, up 400 basis points, so up around 4%, which is very strong because on this channel, one of the indicators we look at for companies is an increasing top line revenue as well as an increasing margin, whether that's gross margin, operating margin, as well as net income margin. Earnings per share of 239 as well, up double digits year on year, which is strong, although we did indicate from the analysis from the institutions and Wall Street that the expectation is it will be negative over the next 4 quarters. And we'll touch a little bit more on free cash flow, as this is one of my favorite metrics to look at for any company that we do analyze. The second pillar is the healthcare sector. Now, Solventum is one that if you have been a shareholder of 3M this year, in fact, from around March, you would have had shares of this company. As we can see, 3M shareholders did receive around 80%. Just for transparency, this is one that I have also sold. In fact, Solventum was one that I sold pretty much on the same day that I did receive their shares. In terms of cash, well, this is positive for 3M. They received 7.7 billion in cash, and what they have done with that, which we will look at shortly, is pay down some of that debt, which is always a good sign in terms of that dividend safety, just to make it stronger moving forwards. They talk about creating 2 world-class publicly held companies, both 3M as well as Solventum. And the third pillar, which maybe we don't take a look at as often on this channel, is that risk and uncertainty. So the PWS, the Essential Public Water Supply Settlement, did reach the final court approval, which is very good. Around 99% of those who were eligible for the earplugs claim have chosen to settle and participate in that, so that is also positive. And another thing in terms of the risk was the PFAS manufacturing. They are expected to end, or in fact exit this by 2025. So lots of positives to note. Yes, this isn't a company that is suddenly disappearing or suddenly is going to drop in the share price, but we just want to take a look at the whole company, and then you'll have your own investment thesis to see whether or not you agree or you consider this to be a buy, hold, or sell. We then move on to something that I quite like to look at, is the free cash flow. Now, we do note in Q1 around 800 million, 0.8 billion. It is down double digits, 12% year on year. When we do look at this free cash flow, you will notice that we typically like to see increasing free cash flow year on year, so a little bit disappointing to note this. We do also note their free cash flow conversion is down around 24 ppts year on year as well, although they do talk about some of the reasons for this. And when we take a look at one of the things that I want to draw your attention to is that net debt, 10.4 billion. It is down double digit year on year. Very, very strong. And their dividends, yes, they do return some money to shareholders, but as we did mention earlier, and we will come on to again, the yield has dropped to around 2.8%. Just something to be aware of. As always, when we review companies, we want to look at their 2024 guidance or the next year. And what we can see here in terms of their 2023 guidance, they had adjusted organic sales growth of negative 4.4%. Nice to note, for 2024, it is anticipated to be flat to plus 2%. So it isn't the greatest because, as always, we want 3 to 7%, but a lot better than the previous year. In terms of the operating margin, something we just discussed, we do like to see top line increase with margin increase. They are anticipating an increase here as well, so that is very positive. And we can see here earnings per share from continuing operations, 680 to 730, essentially a nice increase from 2023. So lots to like about their 2024 guidance. Obviously, a lot of people would like to see this a lot better, but just nice to see that from the previous year, this is moving in the right direction. And then the final thing that we wanted to cover around the dividend. This is a company that has been paying a dividend for a very long time, in fact, 100 plus years. Although, as we will come on to very shortly, they will have lost that dividend king streak, and they will have lost that streak where companies that we typically look at have been paying a dividend without a reduction. So what we also note, distributing around 80.1% of Solventum's outstanding shares to 3M shareholders. And what they're looking at, and remember, when we do look at the free cash flow payout, we want to see a maximum of 60%. They're anticipating 40%, which is a very good sign. But again, they have massively cut that essential dividend moving forwards. So there are no surprises that it should be very low now. What they do say is that they expect their dividend now to be essentially in line with the industrial peers as well as above the S&P 500, something that I don't think is fair to say given the fact the S&P has performed a lot better than this company. And what we can see is whilst there's the second quarter dividend is expected to be declared in May 2024, it is something that we just looked at earlier at the beginning of this episode. And share repurchase, they do say they are stepping back in the market to do this. So let's cover a lot of this information in our own analysis and in this essential presentation that we'll look at now. Firstly, dividend yield, forward-looking 2.78%. Dividend safety 40, it does look to be unsafe. Market cap 55.4 billion. It is a large cap company. Now we do also note here that it was reaffirmed on April 30th that a dividend cut was going to take place, which we have seen of negative 54%. And we can take a look before we look at the dividend aspect in terms of the key metrics. Now in the last recession, they did increase the dividend during the 07-09 crash. They had average growth sales negative 13% with the S&P around negative 12. And we know they had pretty much a near S&P return, negative 54 with the S&P negative 55. Dividend growth, as we've spoken numerous times today, negative 54% dividend cut just yesterday. And over the last 2 years, increasing 2% year on year, significantly lower than the inflationary target on this channel of 4% or more. However, over the last 20 years, 8% year on year. Now, as we can see, before they were a dividend king, they had increased the dividend for 50 years or more. They now reset to zero, and also their uninterrupted dividend streak without a reduction also resets to zero. Now, in terms of dividend yield theory, it is one that is difficult to discuss today in this episode because the 5-year average will have been essentially with the yield when it was significantly higher. So in today's episode, we won't talk about this, but typically dividend yield theory states a company is undervalued when the current yield sits above the 5-year average. What we can say, however, in a forward P basis, 14 versus the 5-year average of 3M of 16.2 is an undervaluation signal in its own right, and we also note that it is lower than the industrial sector of 19.8. So let's take a look at the free cash flow payout, and as always, we do ignore the earnings as it is susceptible to manipulation by management through accounting. We focus on free cash flow, as we said, below 60%, and as they mentioned, 40% is the anticipated rate moving forwards, which is fairly healthy, and we will factor that in when we look at our valuation model and the dividend discount model. It is very healthy, as that does mean that they can increase those dividends at a much faster rate than maybe they perhaps were previously. Free cash flow per share, as we said, we do want this to be increasing over the longer term. We do note a lot of inconsistencies, although it has increased from 2014 791 to 914. Just understand something to note, 2024 the free cash flow is expected to drop from the previous year. In terms of sales growth, ideally we do want companies 3 to 7% as a minimum. As we saw when analyzing their top line revenue, it was very inconsistent, and in fact, whilst this is just the different format to what we saw earlier, we can clearly see here very minimal movement. And if you say inflation is at 4% year on year, in fact, in real terms, their top line revenue has been decreasing. As we spoke a little bit about just not too long ago, they have been returning excess cash to investors through those share buybacks, reducing it year on year. That is something, as they said in their investor presentation, they are anticipating to start or restart, in fact, in quarter 2 and beyond. ROIC, return on invested capital, 10% or more is what you should be targeting for every company, just to give you faith that management are able to effectively allocate their capital. Whilst it has decreased over the longer term, over the last few years, fairly consistent in the mid-20s, and that is fairly healthy for a company of this nature and size. When we look at the margins, again, very healthy, above the minimum 12%. It has been decreasing, which is a sign of operational inefficiency, but the positive to note from their investor presentation, they are anticipating this to go back up to the low 20s, which would be ideal, especially if you add into the fact they're expected to increase their top line revenue. Free cash flow margin above 5%, and they do that very well year on year at the strong double-digit rate. Finally, we get to the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. Remember, this is important because it correlates to balance sheet strength as well as dividend safety, and below 3 is our target, with these numbers being the number of years it would take the company to pay off their debt net of cash on hand year on year. Nice to note 1.33 in 2023, 2024 at 1.69. It is anticipated to increase, but given it is significantly below 3, no worries with their balance sheet, no worries with that dividend safety, especially after that dividend cut, but just bear in mind it has reduced now to around 2.78%. So let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. First model that we are using today, it is the dividend discount model. Now we can see the average growth is negative 10%, given the fact that we did have that dividend cut of 44 or 54% in fact just yesterday. And even before then, we did see some very mediocre increases year on year. In terms of a growth rate moving forwards, now we have gone for 5%, which is a lot higher than what it has historically been and above the inflation. We do believe with that free cash flow payout, in fact, reducing down to 40%, they should be able to essentially increase the dividends at a much healthier rate. With the new dividend amount for the year at $2.80, given the fact that it is 70 cents per share per quarter, we do get an intrinsic value of $98, not too far off the market value. So whilst we have an overvaluation signal here, we would say reasonable valuation based on this model, but as always, bear in mind we're not looking at any one of these models in isolation. We then move on to the DCF model, free cash flow year on year, average growth rate around 1.35%. We've gone pretty much in line with the 10-year average at 1%. With the discount rate, we get the present value of future free cash flows and terminal value. Add the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we do get an intrinsic value of 139, showing some nice undervaluation at the current market value of $100. Now, bear in mind, the intrinsic value here is the average of these two models that we have run through today, and that comes to $118.34. Also remember, if you click on the pinned comment below, you can grab a copy of the valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio as well as those on your watch list. Now, margin of safety, we do allocate and execute at 10% if we believe a company meets the 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that for 3M, it would be a buy up to 106.50. Our personal opinion, 10% is not a sufficient margin of safety to add this company. Then we keep going to this near the current trading price, and we see at a 15% MOS level based on our estimates and judgments that it is an acceptable buy up to $100.59. Now, that is the current trading price. If we keep going, if you wanted a 20% MOS level, a buy up to $95, 25% 89, 30% around 82, 84, but in today's episode, it does just hold a 15% margin of safety. In terms of Wall Street and their expectations, well, they see 7% upside over the next 12 months. Their price target is $107, and as we saw at the beginning of this episode, they do believe that right now this is a hold. Now, for me, this is one that I have sold out of completely. The reasons, as we have run through across in today's episode, the metrics don't look very strong, especially over the longer term. This is going to take quite some time to get back to the company that it was before. The dividend yield has dropped dramatically. It was around 6 to 7% not too long ago. Now it is below 3%, and I believe there are a lot of better other opportunities in the market. Not too long ago, we did add to our UNH position that we did talk about, and that is looking very strongly, and we do anticipate over the coming weeks and months there will be a lot more opportunity with a lot of better other growth stocks than 3M that even probably yield around the same as 3M at that 2 to 3% level. But as always, do your own due diligence and let us know your thoughts whether or not you do believe this has a lot of growth opportunity over the next few years. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are notified of these videos as they drop, and let us know your thoughts about today's episode, whether or not you see 3M as a buy, hold, or sell. As always, we'll see you all on the next one.